Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on July 10th, 2026. We're Elena and Marcus.
And for this week's briefing, we really need to cut through the noise because if you look at the consensus across the street right now, everyone is entirely fixated on the start of Q2 bank earnings.
Yeah, they're looking at that massive, 22% expected earnings per share growth bar and obsessing over minor short-term outflows.
Exactly. But in doing so, the prevailing narrative is completely ignoring a structural trapdoor in the market's plumbing. I mean, we are talking about a critical vulnerability sitting just 0.34% below current trading levels.
Which is incredibly thin. So today, we're going to bridge the gap between the euphoric macroeconomic data we are seeing on the surface and that highly precarious microstructure underneath.
Because, simply put, if that structural trapdoor snaps, those Q2 earnings reports will not matter at all. The flows will just take over.
So to understand the structural reality of the market, rather than just reacting to the media narrative, we always anchor our analysis in the foundational house view. We need to look at what the underlying data is actually doing, devoid of the daily static.
And our proprietary modeling is currently telling a very different story from the consensus. We are seeing structural underlying growth momentum that is actually heating up, but doing so without any signs of panic buying.
To isolate that signal, we rely heavily on the OCM PCA model. And for those of you reviewing our framework, PCA stands for Principal Component Analysis.
The best way to conceptualize this model, to really visualize what it does for your portfolio, is to think of it as a set of premium institutional-grade noise-canceling headphones.
I always find that analogy helpful because the market generates so much daily static.
Precisely. You have localized earnings misses, geopolitical headlines, constant financial media chatter. The PCA model mathematically filters all of that out. What you are left with is the heavy underlying baseline that actually drives asset prices over time.
And when we look through the lens of our 5-year look back this week, the model places the market squarely in a normal reflation regime.
Yeah, and the specific components driving that regime are highly instructive. We track 3 primary engines here. The first is PCA1, which measures global growth.
And that currently sits at a strong positive 0.83, correct?
Correct. Positive 0.83 and visibly accelerating. This means the underlying physical economy, manufacturing, freight, cyclical demand is actively expanding.
Okay, so that's the growth engine. What about rates?
That brings us to PCA2, which tracks rates and reflation. This component is at positive 0.41, so it's showing upward drifting rate pressure.
And our model identifies this as being driven by rising core yields, specifically the 10-year Treasury, alongside strong outperformance from cyclical commodities like copper.
Exactly. And when copper is outperforming, it generally confirms that the physical economy is demanding raw materials for expansion. It aligns perfectly with that positive growth signal we saw in PCA1.
But the third component is really what creates the perfect environment for risk assets right now.
Yeah, PCA3, which is the Economic Surprise Index, is completely flat.
Meaning the macroeconomic data being released is matching baseline expectations almost perfectly.
Exactly. There are no sudden directional shocks hitting the tape to disrupt institutional positioning. Everything is thoroughly predictable.
But here is where we see a crucial divergence in our proprietary modeling. While the 5-year view flags a normal environment, our 3-year robustness check shows something different.
Right. The growth signal on the 3-year check has officially crossed the threshold into euphoria, hitting positive 1.02.
And that specific divergence is probably the most critical structural flag we are monitoring this week.
It is. What structural euphoria means in this context is that the post-2023 growth momentum is structurally outpacing the longer-term historical average.
But the market is digesting this reflationary growth smoothly, right? We are not seeing the extreme impulse shocks that typically accompany a late-cycle blow-off top.
No, not at all. Instead, it is a steady, highly constructive environment that strongly favors cyclicality. We are seeing this confirmed across global equities, including indices like the Kospi.
And it's also vividly reflected in the credit markets. When you look at credit spreads across BB and even CCC tranches, there's a distinct lack of distress.
Exactly. Even when we analyze structured products, things like CLO and CMBS issuances, the steady demand confirms that euphoric growth signal. The credit markets are wide open.
But algorithms and retail traders, well, they do not just buy in a vacuum. If our internal signal confirms a euphoric environment, we have to ask who's actually deploying the capital.
We need to look closely at investor positioning, and we should start with the systematic players, specifically the commodity trading advisors or CTAs.
For those navigating this space, you can essentially view CTAs as the market's algorithmic cruise control systems.
That is a perfect way to put it. These systematic trend followers do not read balance sheets. They do not care about the start of Q2 bank earnings. They operate strictly on momentum and volatility metrics.
So they buy when the price trend is moving up and they sell when the trend breaks.
Precisely. And because the economic surprise index is flat, realized volatility is very low. Lower volatility mathematically allows their risk models to significantly increase their position sizes.
Which explains why market intelligence confirms these systematic players are heavily long global equities and short fixed income right now. Their cruise control is set firmly to buy.
Yeah, they are fully allocated, but running parallel to those institutional algorithms is a massive retail wave.
And the retail investor is buying the dip aggressively. We are seeing them heavily favoring technology, specifically the memory chip leaders and the standard Magnificent 7 cohort.
But the critical variable here is how they're expressing this view. The retail share of options trading is currently hovering at historic highs.
They are pouring billions into short-dated call options. And honestly, I look at this massive retail options volume and I see the primary driver of current market mechanics.
You think retail is leading the institutions here?
I do. I think retail is forcing the issue, supplying the initial aggressive directional force, and the institutions are basically just reacting to it.
I actually have to strongly disagree with that assessment. The retail options volume is a spark, certainly. But a spark without fuel burns out in a single trading session.
But look at the sheer volume of contracts being traded.
The volume is high, but the actual structural fuel here is institutional. The algorithmic CTAs are the ones operating with massive scale. If retail investors buy a wave of call options, but the CTAs are in a de-risking regime, that retail momentum hits a brick wall.
So you're saying the algorithms are the engine driving the bus?
Yes, and the retail trader is just surfing the massive liquidity wake created by those algorithms.
That is a fair pushback on the scale of capital. But I would argue that retail options are what force the market makers to continuously buy the underlying stock to hedge their books.
Which is true, they do have to hedge.
And that hedging creates the upward price action that the CTAs are programmed to blindly follow. It creates a closed-loop momentum cycle. The algorithms see the trend moving up, they allocate more capital, which in turn emboldens the retail trader to buy even more short-dated options.
Okay, we can agree that it has become a self-feeding mechanism. Both groups are feeding a momentum loop that entirely ignores traditional valuation metrics.
Exactly. But for that momentum loop to continue functioning without collapsing, both the systematic algorithms and the retail traders require a perfectly stable foundation.
They need the macroeconomic environment to remain entirely predictable. Which brings us to the macro data that is supporting this entire structure.
We reviewed the week's major labor and economic releases, and the primary takeaway is that the U.S. economy is solid, but it's not overly hot.
Yeah, the recent payroll data really stabilized expectations. We saw job creation numbers and wage growth metrics that were contained.
Meaning wages are not spiraling upward in a way that would trigger secondary inflation.
And the mechanism of why that specific labor data matters is crucial for everyday liquidity. Because the labor market is not wildly overheating, the center of the Federal Open Market Committee now has the political cover to look past the early year inflation spikes.
So the central bank does not have to be as aggressive with monetary tightening as the street feared a few months ago.
Exactly. And this realization is triggering a structural reversal of the hawkish Fed trade.
Let's break down the mechanics of that hawkish Fed unwind for the listener. For months, the consensus across the street was anticipating higher interest rates for longer.
To play that, institutions built massive long positions in the U.S. dollar and massive short positions in the Treasury market.
Specifically targeting the 2-year and 10-year yields. Because bond prices fall as yields rise, shorting treasuries was the standard playbook.
But now, because the labor data is contained, those yields are fundamentally capped. Institutions are being forced to unwind those positions.
They're selling dollars and buying back treasuries to cover their shorts.
Exactly. And for the everyday investor managing a portfolio, this predictable macroeconomic environment acts as a fundamental green light.
Because when there are no sudden potholes in the economic data, market volatility drops.
And when volatility drops, the systematic algorithms feel perfectly safe keeping their massive equity positions intact. This stable macro foundation is the exact fuel powering the reflationary, euphoric growth our PCA model is detecting.
So on the surface, it looks like an ideal scenario. Growth is euphoric, the macro data is stable, the Fed is stepping back, and the algorithms are buying.
But this is exactly where we have to look under the hood. Our proprietary modeling reveals a highly precarious trapdoor in the structural setup of the market's plumbing.
And to really understand the risk here, we have to demystify dealer gamma.
Dealer gamma can sound like impenetrable institutional jargon, but the underlying mechanism is quite straightforward when you look at the incentives.
Think of options dealers as Wall Street's middlemen. They are the institutions writing the insurance policies and selling the call options that the retail crowd is aggressively buying.
But these dealers do not want to take directional risk. They just want to collect the spread. To remain market neutral, they have to constantly hedge their books through a process called delta hedging.
And this is where the mechanics completely dictate market behavior. When a dealer sells a call option to a retail investor, the dealer is effectively short that call.
So to hedge against the stop price going up, the dealer must buy a certain amount of the underlying stock.
And as the stock price moves, the required hedge changes. The rate of that change is gamma.
Precisely. And dealer behavior flips entirely depending on whether their overall book is in a state of long gamma or short gamma.
Walk us through what happens when they are long gamma.
When dealers are in a state of long gamma, they act as the market's shock absorbers. Mechanically, if the market starts to dip, the delta on their options exposure decreases, which forces them to buy the underlying stock to stay neutral.
And conversely, if the market rallies, they are forced to sell the stock.
Exactly. This mechanical buying of dips and selling of rallies naturally pins the market in place, artificially suppressing volatility.
Applying that exact mechanism to the current setup, our models show the market is currently heavily long gamma, to the tune of positive $36.6 billion.
The dealers are acting as massive shock absorbers right now. This is exactly why the S&P 500 spot price is anchored so tightly at 7,575.
Furthermore, because of the retail demand we discussed, there is a massive wall of call options sitting at 7,600. We refer to that as the upside magnet.
Yeah, anytime the market tries to organically rally towards 7,600, dealers are mathematically forced to sell stock into that rally, effectively capping the upside.
The shock absorbers are working as intended for now, but the structural danger lies just below the surface.
It does. The exact zero-G pivot, or the gamma flip line, where dealers transition from being long gamma to short gamma, is sitting at 7,549.
I want to pause on that specific number because the structural reality is staggering. The current spot price is 7,575. The flip line is 7,549.
It is an incredibly thin cushion.
We are talking about a buffer of just 26 points, or roughly 0.34%, below current trading levels. It is like walking on a frozen lake.
Above 7,549, the ice is 3 feet thick. The shock absorbers are working, you can jump up and down on it.
But take one step past that line, and the ice is suddenly paper thin. If 7,549 breaches, our models show an immediate liquidity air pocket.
You suddenly have dealers flipping from shock absorbers to amplifiers, completely stripping away the floor.
Does anything stop that free fall before the next major level at 7,400?
Structurally, very little stops it. If the index breaches 7,549, the math inverts. The dealers instantly transition from shock absorbers into amplifiers.
Because they are now short gamma.
Exactly.
Yeah.
If the market drops further, their risk models force them to aggressively sell the underlying stock to protect themselves.
Their forced hedging becomes entirely pro-cyclical, meaning their very act of trying to manage risk actually causes the exact market acceleration they're trying to protect against.
They have to sell into weakness, creating a structural void that accelerates a rapid dealer-amplified flush all the way down to the next true layer of market support, which our models locate at 7,400.
That is a sheer 150-point cliff. And it perfectly sets up what we identify as this week's pain trade.
Yeah, we have to synthesize the euphoric macro growth signal from our PCA model with this incredibly fragile, paper-thin gamma trapdoor in the microplumbing.
The consensus across the street is currently looking entirely the wrong way.
The crowd, both the retail options traders and the systematic CTAs, are caught off guard by this plumbing setup.
The financial media is entirely distracted by the start of Q2 bank earnings. They are debating whether corporate balance sheets can clear that 22% earnings per share growth hurdle.
And they are completely ignoring the structural fragility sitting 26 points below the market.
Therefore, the actual pain trade for this week is not an earnings miss. The The pain trade is a sudden, seemingly inexplicable 30-point drop in the S&P 500 that hits that 7,549 trigger without any fundamental news catalyst.
Because if that happens, the algorithmic trapdoor opens. The CTAs will see their momentum signals break and begin liquidating,
while the dealers simultaneously amplify the selling pressure down to 7,400. The street will be caught holding the bag simply because they did not understand the underlying market mechanics.
Which brings us to the actionable summary for the individual investor reviewing their portfolio this week.
The strategic approach here is entirely binary, dictated by that critical 7,549 pivot line.
Exactly. Here's the first scenario. If the index holds above 7,549, you should expect a tight range-bound market.
The shock absorbers are doing their job, and volatility will remain suppressed.
In this specific environment, the mathematical play is to sell the rips as the market approaches the 7,600 upside magnet and buy the minor dips, knowing the dealers are mechanically supporting the floor.
But the second scenario requires a completely different posture.
If 7,549 breaks, a standard passive holding strategy will severely hurt your portfolio. The contained mean-reverting environment we just described is completely invalidated.
Downside disaster protection must be targeted precisely at the 7,400 support level, because the structural mechanics dictate a fast, liquidity-driven flush to that exact depth.
It is a fascinating and dangerous juxtaposition. We have a macroeconomic environment radiating stability and euphoric growth, sitting right on top of market plumbing that is balanced on a razor's edge.
Which brings to mind one final provocative thought to consider as you review your allocations this week.
We noted earlier that retail options trading is hovering at historic highs, heavily concentrated in upward momentum technology trades.
And the sheer volume of these options is what forces the dealers to take on these massive unbalanced hedging positions in the first place.
Exactly. So if this relentless retail demand for calls is creating the upside magnets and the downside trapdoors, we have to ask a difficult question.
Are everyday investors actually the ones forcing Wall Street to build these precarious gamma cliffs?
Through our collective pursuit of leveraged momentum, are we structurally engineering our own market fragility? It is something you must factor into your risk framework.
See you next week, wherever the flows take us.